to talk about Twitter today, right? If you love it, why not own it? I'm a fan, and everybody else is too. Twitter fans will soon get the chance to invest in the social media giant once it unleashes its IPO. But should small investors climb aboard? Joining me now, David Nelson, chief strategist at Bell Point Asset Management, and Alan Haft, author of the book You Can Never Be Too Rich. Absolutely true. David, I'm going to start with you. You are a bull, and in part because of this news today about Comcast, NBC Universal. Tell us about that first.
I think that's a really important story. It's very clear that businesses want to partner up with Twitter, and Comcast, NBC Universal announced this strategic partnership, and what this means is they're going to integrate Twitter as part of the viewing experience, and you'll be actually on Twitter, you'll see a tweet, you'll click on it, it might take you right to programming. They're going to participate in the revenue and income stream on this.
I see some actual revenues and possibly earnings coming out of this, Alan, which would be something new because this company has had no earnings. Why do you not like this company, Alan?
You know, if you're a gambler, you got a shot at making a few bucks here. But if you're an investor, you have to look at the fundamentals, right? Because here we go again, Jerry. It's all about advertising. And the advertising dollars that are being spent on Twitter are not that effective. They're very lukewarm. It's very lukewarm received by the advertisers out there. The conversions, the cost of conversion is double the cost on Twitter than it is on other social platforms. And if they add more advertising into the Twitter stream, it's going to ruin the user experience. So the only other way to get the dollars up is to add more users to the base. And right now the user base is slowing in the United States, and in the international markets, China doesn't even allow Twitter in the country, and a lot of the other markets are fragmented by smaller Twitter type of companies that are going to be very competitive for Twitter once it starts to really roll out there.
You're making some very good points here. And I have to say, you know, you look at what's going on with this company. They just released some of their results. It's been a black box what they're doing. We haven't known, and we just found out that they lost $67 million in the first half of the year.
This is an early stage company, Jerry, and I think the way you have to look at it, think of it like a biotech that's had a great phase 1 and phase 2 trial, and now they're going into phase 3. They got 218 million users of this product. I use it. Alan uses it, and you use it. We use it for a reason because there's an advantage here.
Alan, to you, it's just the fact that it's a brand we know and we use. Is that reason to buy the stock, A? And B, could we be looking at another Facebook?
Right. Well, listen, I love Twitter. I'm on it. I use it a lot for my news feeds to get up-to-date stories. But when you invest in a company, you have to look at it not from is it a cool technology? Do you like to use it? You have to look at it, is the company going to make money? And right now, I agree. It's a great company. It's got a lot of brand recognition out there. But you're going to be buying in at a very high valuation. So what you have to ask yourself is Twitter going to earn into that valuation? So what I'm telling people out there is don't jump in. There's no rush. Just don't jump in. Let's see how it develops. Unless you're a gambler, just sit back and watch it go and see if they're actually going to start creating some earnings off of this model.
David, respond.
Okay. First of all, you're not going to have a Facebook fiasco. Goldman Sachs is not going to let that happen. They're not going to make the same mistakes that Morgan Stanley did, where they drove up and hyped up the stock, and then when there was no institutional interest, and there's a lot of institutional interest in this stock, they passed it on to the retail investor. That's not going to happen this time. And also, I will point out that Twitter is taking a very responsible attitude here. They want to raise $1 billion. They don't want it to let it run completely away and get priced out of control. And if they have to, they'll float more shares to keep that price down.
Alan, here's my problem with Twitter, and tell me if you agree with this. So if I'm an individual investor, okay, I'm not getting in at the offer price. I'm not an insider. I didn't help build this company. I'm not one of the investment bankers. I'm not even one of the best clients of one of these investment bankers. So there's no way I'm going to get a great price. I'm not going to see the big run-up that these folks are going to see. Buying on that first day, even that first week, is a true risk, is it not?
Absolutely, and that's why I say just sit back and let's see how the story develops. There's a vast ocean of investments to choose from out there, Jerry, and there are far more prudent choices that have long track records, economic moats that surround them, and rock-solid financials. So where your dollars go, don't buy into the hype. Watch the stock, but look at all the other options you have out there. And I'll tell you right now, there's a lot better choices out there for my money and for a lot of the people I'm talking to.
I want an economic moat. I've never had an economic moat. That's a great phrase.
Right.
Thanks for coming on, and thanks to arguing the bull side, because I know a lot of people out there are going to be watching these shares and want to get in. Thanks to both of you. Alan and David, great points, both of you. Thank you.
Thanks for having us.